Adjusting Entries with James and Harper.
If you haven't heard of adjusting entries before, it's the name that we give to the journal entries that we post at the end of each accounting period in order to bring our books into alignment with the accrual basis of accounting. Sound complicated? Well, it is kind of. Financial accounting is the process of recording, summarizing, and analyzing an entity's financial transactions and reporting them in financial statements to its existing and potential investors, lenders, and creditors. But the key takeaway here is that payments and invoices shouldn't dictate when we recognize our revenues or expenses. Instead, we need to think about the substance behind each transaction. That's the real trigger. But the problem is that this doesn't just happen naturally, and that's when adjusting entries come in. Let me explain. The past and the future, with us being bang in the middle, balancing on a tightrope in the present. In a prepayment, goods or services have been paid for in advance. So that means that the payment happened back in the past for goods or services that are going to be delivered or consumed in the future. The problem here is that normally the invoice and payment part of the transaction naturally triggers an accounting entry that recognizes the whole transaction in the past. So if we were the buyer, then we would have recognized an expense in the past. And if we were the seller, then we would have recognized the revenue in the past. But we are accrual accounting, so revenue should be recorded as it's earned and expenses should be recorded as they are incurred. The goods or services are going to be provided in the future, so the revenues or expenses should also be recognized in the future, not the past. So right now, before the period closes, we've still got a bit more time to make changes in the past. We need to post an adjusting entry to reverse out those revenues or expenses from the income statement and hold them in the balance sheet where they don't impact our past financial performance.
Thank you, James, for that beautiful introduction to prepayments and accruals adjusting entries. Like you said, they can be a bit tricky, but the fun is in the challenge. This is next level, so let's look at a few examples together. Accrued expenses. Whenever you see the word accrued, you should always think still owing, still outstanding. The expense will increase because it is still owing, and the accrued expense will be seen as a liability because it is an amount still payable. Example, an account for repairs, 500 Rand, is still outstanding. The repairs will increase at the income statement and it will increase trade and other payables at the balance sheet. Prepaid expenses. Expenses paid in advance will be seen as an asset and posted to trade and other receivables at the balance sheet. However, it has to be subtracted from the expenses for the current financial year because the expense has not yet been incurred. Example, the rates amount includes 2,500 Rand in respect of the next financial year. Rates will decrease with 2,500 Rand at the income statement and will increase with 2,500 Rand at the balance sheet, at trade and other receivables.